For most people, a financial crash feels like chaos, a storm with no warning, a sudden collapse that destroys lives, jobs, savings, and nations. A tragedy of miscalculation, greed, or bad luck. But what if the chaos isn't chaos at all? What if behind the panic, the headlines, and the collapsing markets, there are hands you never see, hands that pull the strings, fuel the panic, trigger the fall, and then profit from the wreckage they helped create? What if the world's biggest crashes aren't accidents, but engineered opportunities? And what if the systems designed to prevent disaster are controlled by the same forces that benefit from it? This is the story of how modern economies are quietly steered, how crises become profitable, and how the same invisible forces that create a collapse often shape the bailout that follows. This is a story of power, a kind of power most people never see, a power that decides who loses everything and who becomes richer than ever. Section 1. Origins of Invisible Control. To find the beginning of this hidden system, you have to go back more than 300 years, to the birth of central banking, sovereign loans, and early stock markets. Back then, markets were small, governments were desperate, and very few people had enough gold, silver, or credit to influence outcomes on their own. But the ones who did, royal financiers, banking houses, trading networks, and private lenders, discovered something extraordinary. Governments could be controlled through debt. Markets could be controlled through fear. And entire economies could be shaped through selective access to money. When nations went to war, they borrowed from private lenders. When trade collapsed, they turned to wealthy families for rescue. When monarchies fell, their debt remained, and someone still got paid. Power wasn't held by kings or generals. It was held by the people who financed them. This was the birth of a system where financial crises became tools, and the people who controlled credit controlled everything. Section 2. The rise of market manipulators. Fast forward to the 1800s and early 1900s. Markets had grown. Industrial empires had emerged. Railroads, steel, oil, and global trade had reshaped the world. And with these new markets came a new kind of influence. Speculators who realized that panic wasn't something to fear. Panic was something to profit from. When markets soared, they made money. When markets crashed, they made even more. They discovered that by controlling information, buying newspapers, funding politicians, or quietly spreading rumors, they could trigger movements that benefited them while hurting everyone else. During booms, they invested early, then offloaded their assets at the peak. During busts, they bought everything back at pennies on the dollar. This pattern became a cycle so predictable that the same families rose to power generation after generation. And as markets globalized, their influence grew larger than some governments. Section 3. The turning point. Early central banks. By the early 1900s, governments understood the danger. Crashes were becoming more violent. Speculators were becoming too powerful. And entire economies were collapsing because of a handful of financial players. So nations created a solution that they believed would stabilize the system: central banks. But central banks didn't eliminate powerful financial actors. Central banks concentrated them, because the same private institutions, banking families, corporate lenders, and international financiers became the ones who influenced monetary policy. Interest rates, credit access, liquidity, and bailouts. The fox wasn't removed from the henhouse. The fox was put in charge of it. And with central banks, a new tool emerged. Market manipulation disguised as stabilization. Interest rates could be raised to cool off a boom, triggering a crash. Interest rates could be lowered to rescue a bust, fueling the next bubble. Money supply became a weapon. Policy became a lever. Crises became manageable and therefore profitable. Section 4. The Great Depression. A warning ignored. When the stock market crashed in 1929, the panic was devastating. But what few people knew then was that the crash didn't just destroy wealth, it transferred wealth. As millions lost their savings, a small number of financial groups bought entire industries for a fraction of their value. Banks that collapsed were bought by larger banks. Companies that failed were absorbed by conglomerates. Families that lost farms or homes transferred their assets to rising investment groups. The worst financial disaster in modern history became the greatest consolidation of wealth the world had ever seen. And the pattern was set. Crashes were not just economic failures. Crashes were opportunities for the prepared and the powerful. Governments responded with new laws, new protections, new oversight. But over time, those protections were slowly dismantled, not by ordinary citizens, but by the same institutions that profited from collapses. The cycle was restored. The invisible hands regained control. Section 5. The modern era. Manipulation goes global. By the 1980s and 1990s, financial markets had evolved into something enormous. Too fast, too complex, too interconnected for any single government to control. But they were perfect for those who understood how to manipulate them. Debt became a global industry. Derivatives became weapons of influence. Banks became too big to fail, and therefore immune to consequences. For ordinary people, crashes became disasters. For the invisible hands behind the system, crashes became strategic resets. When markets overheated, they quietly pulled out. When prices collapsed, they bought back in. When banks failed, they were bailed out. When companies went bankrupt, their assets were sold for scraps to the same investors who profited from the collapse. Risk was socialized. Profits were privatized. The pattern repeated again and again. In Asia in 1997, in Russia in 1998, in the dot-com crash of 2000, and then on a scale never seen before. Section 6. The 2008 collapse. The playbook exposed 2008 was the moment the world saw how the invisible hands truly worked. Banks created toxic assets. Rating agencies blessed them. Investors sold them to pension funds, governments, and families. And when the entire structure collapsed, brought down by the same people who built it, the world expected accountability. Instead, something else happened. The biggest bailout in human history. Not for homeowners, not for workers, not for the millions who lost jobs or savings. The bailouts went directly to the institutions that caused the crisis. And the most extraordinary part? Those institutions didn't just survive, they grew. The crisis made them richer, bigger, more powerful than ever. It was the perfect demonstration of a system where failure is rewarded, where risk doesn't matter, and where the same invisible elite that pushes the system to collapse is the one rescued with public money. The playbook was exposed and then normalized. Section 7. Aftermath. Failed fixes and false solutions. In the wake of 2008, governments around the world promised reform, but the reforms never targeted the real mechanisms of control. Instead of limiting speculation, markets became more automated. Instead of restricting leverage, banks used new loopholes. Instead of reducing risk, derivatives exploded in scale. The global economy became more fragile, more interconnected, more dependent on the same handful of institutions that caused the previous crises. Today, just 20 financial entities control the majority of global assets. A few central banks influence trillions in markets with a single announcement. A few hedge funds can move entire economies with one trade, and the system is more volatile than ever. Every boom is bigger, every crash is deeper, every bailout is more expensive. Section 8. Modern parallels. The pattern returns. In the last decade, the cycle has repeated with brutal clarity. In 2020, markets collapsed overnight. Tens of millions lost their jobs. Small businesses disappeared. Economies froze. And yet the wealthiest institutions didn't just survive, they expanded. As markets crashed, they bought everything. As stimulus flooded in, their assets soared. As businesses closed, their competitors disappeared. Crises weren't interruptions, crises were accelerators. The same pattern continued in crypto collapses, housing instability, bank failures in 2023, currency crises, and emerging market debt defaults. Every crisis follows the same script: destabilize, collapse, consolidate, profit, repeat. The hands remain invisible, but the results are not. Section 9. The present. Who benefits now? Today, the world stands on the edge of another reset. Global debt has reached levels never seen in history. Interest rates rise and fall at the discretion of a few. Markets move based on decisions made behind closed doors. And the people who benefit most are not governments, not citizens, not small investors, but the same quiet network of financial actors who have been profiting from crises for centuries. These are the people who don't lose in crashes. They don't fear recessions. They don't panic when markets collapse, because they understand the truth. Crashes aren't the end of the system. Crashes are part of the system. Conclusion. 3 takeaways. First, crashes are not random accidents. They are predictable outcomes of a system designed to reward those who understand its cycles. Second, bailouts are not acts of rescue. They are acts of preservation, ensuring the same institutions remain in control after every collapse. Third, the real power in the global economy is not held by governments or elections, but by the people who can influence markets, control liquidity, direct credit, and decide who gets saved. The invisible hands that manipulate crises are not illusions. They are reality. And the next crash, the next bailout, the next transfer of wealth may already be in motion. The real question is simple. Will the world continue to follow a system where profit is made from collapse? Or will the next crisis finally expose the hands that control it? Because the story of the global economy has never been about stability. It has always been about power. And the question now is, who will hold that power in the next collapse?